Hello and welcome to Chapter 13, Financing for Startups from the Entrepreneurship, the Practice and Mindset Second Edition textbook. So in this chapter, we are now getting into more in depth of the financing for startup, which is perhaps one of the difficult things for startups to establish their business. You can have the idea, you can have the concept, you can have potential customers, but if there's no financing for the startup, it really can't take off. And so we're going to talk about the various ways that companies can finance, or startups can actually finance their startup, right? If that makes any sense, right? Because last in chapter 12, we talk about bootstrapping, and this one we're getting into the financial aspect of it. So the first, one of the things we're talking about is defining what is equity financing, right? Equity financing, to put in short, is the sale of shares of stock in exchange for cash, right? Even though, as we talked about in chapter 12, bootstrapping may be a good start, as the company begins to grow and show potential, it has to look for the possibility of equity financing, right? Equity financing also includes financial resources to produce and sell the product, right? You need the finances in order to, it provides the entrepreneur the capital to run the business, to produce and sell the product. At times, or most of the time, what happens is the entrepreneur, the person starting the company, raising money becomes a full-time job. I've talked to business owners who, in this phase, especially in the startup world, when they're raising out money, it really does become their full-time job, and that's their main focus because it's difficult to get that equity financing. It's not easy. The rule to secure a better deal with investors at a large stage is generally avoid seeking investment for as long as possible, because it'll give you a much more time to grow and value the business higher, and you can secure a better business deal instead of marrying yourself in a very bad deal at the very beginning, which can bite you in the end at the later stages of the company. Competition may be driving to look for investment, right? For example, if you have proprietary technology as a proven market, but you need additional funds to get the version of this technology produced at a larger market, then of course equity financing is going to be the next big thing that you get. Another thing about is splitting the ownership pie. When you own the company, you own 100% of it, right? Of a small pie. Once you start getting investments, your pie becomes bigger, right? What that means is your investment to growth, the pie keeps getting bigger, meaning you're gonna have to share that pie with other folks. If the company does well, your smaller slice of the bigger pie will be much larger. As you need to get away from equity in exchange for investment, the company no longer is fully yours. So just note that once you give equity away in the company's not fully all yours. So, for example, Google gave up the majority of its ownership. So, the co-founders of Google, Larry Page and Sergey Brin, collectively own just 16% of Google stock. Those 16% from the founders may not sound like much. 16% of enormous Google size is pretty lucrative. So 16% of Google at the time of when this presentation was done is about $128 billion. So it's not bad. But, dividing the pie can cripple a startup team. So what I would say for startups to have, say, for example, you have a group of 5 individuals in your startup company, I highly recommend that you split up the pie at the very beginning, at the early stages of the startup company, when there's really no money involved in terms of you barely don't have any equity financing and maybe just you're bootstrapping this thing. There's really no money involved yet. divide up the shares, divide up the equity at that time. It becomes harder and harder to divide up the equity as money starts coming in, because people will be like, well, I put in my sweat equity in this, I put in this, and it's going to become harder. People turn a little fishy once money starts getting involved. So I highly encourage you creating a process for allocating equity based on contributions, including time, money, intellectual property, and other resources. So depending on how, so for example, if someone contributed money to the startup at the very early stages, that has to be a contribution along with time or any other resource that they provide for the company. So there are stages of equity financing. You have the seed stage financing, which is modest money to help entrepreneurs prove a concept. So this is the very early stages. You can receive some type of seed stage financing. And again, it's just small amounts of money in order to prove your concept. Once you prove your concept, then of course go startup financing, money to enable them now, of course, to implement the idea. And so these are the very early stages: seed stage, and of course startup financing. The early stage financing, now that becomes, once you've gone past the seed stage fund, you're looking at early stage financing. That's larger amounts of funds for a product or service that's tested. So, of course, it's larger amounts of funds for companies that have a team or a product tested or piloted, but show, of course, little revenue. So once you get to seed stage, right, let's prove a concept, let's prove an idea. Once you get that right, it's early stage financing. You're proving that idea, that you've tested it, but you really don't have much revenues yet. That's when you get into the early stage financing. The second or later stage financing, as the business grows and takes in more revenue, entrepreneurs may seek more financing later down the road. That just means that you're growing exponentially high. You're growing big. If you're seeking later stage financing, it means you've grown. It's called maybe Series A or Series B, depending on where you're at in the stage. It just means that your company's growing, but you're not making enough revenue for the growth. Like, think, for example, Lyft or Uber, for example, right? They're not making revenue. They're still in the later stages of financing. So they still have, I believe they still have not hit a revenue yet. But that's kind of an example of a later stage financing. Third or mezzanine stage of financing, that's through IPOs, of course, stock options. So, and that, of course, that or IPO, initial public offering, that is usually not the case for all startup companies. So don't think that because you have a startup company that you're going to get to the stage of IPOs. Getting to the IPO stage is very difficult, usually reserved for the unicorns in the startup world, which we'll talk about. What is a unicorn? So again, continuing on with the forms of equity financing, entrepreneurs have several equity financing options. So the 3 F's: family, friends, and fools. Angel investors and venture capitalists. So angel investors. So the 3 F's, going back to the 3 F's: family, friends, and fools. Usually that's done through bootstrapping. When we talked about bootstrapping, angel investors, that's typically an individual who funds startups, and the venture capitalist, right? And those where the big money comes in. They invest for the long-term growth potential. They invest heavy amounts of money, but they want their money returned within less than 5 years. And they want it. So if they give you, for example, $20 million, they want a return on investment of 10 times what they invested in. So the difference between, we talk about angel investors and VCs. Angel investors typically look at the C stage and startup entrepreneurs. They look at the very early stages of the company. It's usually just one individual, an angel investor. Venture capitalists are much more way beyond the C stage. They're looking perhaps at your, Series A, maybe Series B area of your company. most venture capitalists, not all, but they do invest in startups, but and more likely to invest in companies again in the earlier third stage of the businesses, not at the seed stage fund. They won't do that. Most of them won't. And of course, venture capitalists is usually an office of individuals, a group of individuals who invest. Before entrepreneurs seek equity investment, highly recommend that you know the value of your company. That's where you need to do your homework. So, of course, because the reason is because you have to know how much equity to give up. When it comes to fundraising, most investors will expect to see an approximate valuation of your business. So, of course, you can. So, in order for that to happen, of course, so that both the entrepreneur and investor can negotiate the equity percentage and division of the ownership. So how do you go about that? How can entrepreneurs value their companies? Of course, there are available tools online to assess their company's worth. You can also hire individuals to do so. So, of course, entrepreneurs usually value their companies based on the firm's potential. So, of course, you have sites such as Biz Buy Sell and BizQuest that will find out how much your company's worth. So, for example, a company that's valued at 10 million at profitability after 5 years could mean that it was a fraction of that price at the startup stage. Of course, you can also seek counsel from lawyers and accountants, but of course, that's going to cost you money. And don't overvalue your company, right? Because it will put your reputation at risk with venture capitalists. So, how do investors value startups? So, there are several ways. The criteria to attract investors. So, of course, they want to know your experience on your team's past successes. So, that's one. How many people use your product or service? So, they want to know the numbers. Even if your business is not currently profitable, for example, having 100,000 users proves to the investor you have the potential of a scalable business if you have the proper amount of funding. The investors are going to know, like, at the startup stage, that if you're not profitable, they'll understand that. If they see traction in the company, if they have 100,000 users and they're trying to make a profitability, but they just need the extra capital investment, then they'll look at it. Having a distribution channel place would be appreciated, of course. So, of course, Peter Thiel, one of the PayPal co-founders, believes that poor distribution, not product, is the number one cause of failure. So, of course, distribution is extremely important. Negotiate to decide on evaluation. It often takes a lot of negotiation before entrepreneurs and investors agree on what they both consider fair valuation of the money. Pre-money value, that's of course before financing. And of course, post-money value, of course, after the financing has been involved. So, as I mentioned earlier about the unicorn, there's this phase, or there's this term called unicorn for startup companies. Unicorns, it's like the 1% of the 1%, right? It's like the cream of la crop of companies. These are these tech startups that have received a $1 billion valuation, meaning their value is tremendous. But of course, they haven't hit they haven't hit profits that they should. Like, think Uber. Uber is a great example of a unicorn. A tremendous company that has $1 billion valuation plus, but it hasn't hit profit. It's rare. It's really rare for a startup company or a tech startup to hit the unicorn stage. It's not a commonality. And then, of course, there is, when you hear the word convertible debt, that's usually when you're out there seeking financing, you'll hear this term called convertible debt. Basically, it's a short-term loan that could be turned into equity. Because valuation is so complicated, usually investors and entrepreneurs turn to this convertible debt, which is basically also another word for convertible bond or convertible note. It's basically a short-term loan that could be turned into equity when future financing is issued. So it's basically a middle ground between debt and equity financing. Of course, the initial debt converts to shares of stock. So, for example, the initial debt converts to shares of a stock at a degree certain point, called the conversion event. Entrepreneurs, investors may agree to the conversion after a product reaches 100,000 in profit or achieves 1 million in revenue. So, of course, again, one of the good things about this is valuation becomes easier. Valuation becomes easier for the first round of financing. But however, you do run the risk of having your money tied up into debt, converted into equity. So, if your profits don't reach $100,000 or 1 million, it could file for bankruptcy, right? So be very careful as to how you do a convertible debt. Should that be the way to move forward with your company? Angel investors are individuals who use their personal capital, their personal asset money, to invest in entrepreneurship ventures. Angel investors can add a tremendous amount of value to a company. They can provide the skills, lucrative contacts, experience. So they can add a tremendous amount. Usually, angel investor money can range between $25,000 and $100,000. So they're not looking. They don't. Most angel investors don't have $20 million sitting around. Usually, that's the venture capitalists who have that type of money. But angel investors, again, it's the individual that provides maybe $25,000 to $100,000, and they provide, can provide expertise, contacts, but they also are looking for a return on their investment. You can find angel investors like AngelList, referrals, networks, having someone vouch for you. There are also some universities, the bigger institutions, are starting to, especially the alumni associations, are starting to create their own angel investor list. So perhaps you may look into look at your alumni office and see if there's an angel group involved with your alumni association. So that may be another way to look at. Again, the types of angel investors, most of them, have successfully started and operate their own businesses, whether or not they're still running. So they usually will of course provide some assistance as to grow your company if they invest in your company. Corporate angels are usually former business executives, usually from big multinational companies, and of course they're using the money to invest. Of course, while they want to seek a profit, they may want to have a bigger part of the company. Often wanting to be part of the company itself. And professional angels, that's of course doctors, lawyers, accountants, dentists who have money who want to invest it. They're usually silent investors because some of them, like consultants, may wish to be taken on by the company as paid advisors. So don't shy away from professional angels, from the doctors, lawyers, and dentists, and accountants and consultants type groups. Sometimes they're the overlooked group. If you're familiar with Texas Roadhouse, the restaurant, it has a very unique story because Texas Roadhouse, the restaurant, there was no, at the very beginning of the company, the founder of it actually got professional angels. He got like 4 or 5 doctors to invest in his idea of this Texas Roadhouse, or not. It wasn't an idea, but it was a restaurant. To invest in his Texas Roadhouse restaurant, because restaurants are one of the most difficult things to get investors in. A lot of people don't like to invest in restaurants because of the high turnover rate of restaurants. But he looked for professional angels, and he got the money. And of course, Texas Roadhouse, one of the largest restaurants in the nation. Look at professional angels. Don't be afraid to look at those. Again, business angels, enthusiast angels, micromanagement angels who achieve success in their own companies and want to be involved in a venture they invest in. So, uh, angel groups pool funds to invest in a venture to work together. Again, sort of the same thing as an angel investor, but it's a larger group of individuals. For example, Tech Coast Angels is one of the Gold Seeds. Focuses solely on women-led startups. Tech Coast Angels looks for technology startups in particular. Professional money managers. VCs are often former or current entrepreneurs, but unlike angels, they're mostly professional money managers. They look for opportunities to run their investments. VCs also look for opportunities 10 times their investment. Of course, they own ownership and equity in different companies. Not impossible for startups to receive venture capital, but very difficult to receive that. It's rare for a C-stage entrepreneur to receive venture capital. So not impossible, but very difficult. A brief history of venture capital. So just going to give you a brief history about it. Not going to go into very detail. It dates back to the 20th century of when venture capital happened. So the Rockefellers, Bezimers, and Whitneys were looking to earn profits by investing in promising young companies. Our ARD, American Research and Development, of course, was recognized by enormously successful investment in DEC. So today, RADC is recognized as an enormous successful investment in digital equipment company. So again, it's one of the it's first things that happens when it comes to venture capital. And of course, the introduction of the Small Business Investment Act of 1958 furthered the progress of the industry. It officially allows small business investment companies, SBICs, to finance entrepreneurial ventures seeking startup capital. So in the 60s, you saw the experience of my boom of young companies going public. Then, of course, in 1979, the pension funds could invest in venture capital for the first time. So that was a tremendous benefit. So pension funds are able to invest in that. The dot-com bubble came up at the internet in the 1990s. Of course, after a slow period through the 1990s, the dot-com bubble came as the internet began to thrive. And of course, you saw the boom of pop-ups such as Amazon, American Online, eBay, and Yahoo became some of those first tech startup firms in the dot-com bubble to receive venture capital funding. So how venture capital works? Basically, VCs take an interest in entrepreneurs. Who they find that, first of all, they look at the entrepreneur, they look at the team, whether they like them or not, and see if this business is going to grow viable. And also, VCs want to ensure that your goals are aligned with theirs. VCs are not going to invest in a company that doesn't align with their goals. Every VC firm has goals. They look at goal. They have goals for growth, control, and harvest, which is the stage at which they will cash in their investment. So they look at that and to make sure that they all align together before investing. Investors also look for great teams, big markets, and unique and innovative ideas. Those are the top things that they look for. There's some things that investors look at, right? Investors would rather have an A team with a B idea than a B team with an A idea. Meaning they rather have an amazing team with a okay idea than a not so great team with a great idea, because a great team will make it happen. A not so great team is not going to make things happen. So of course, finding the right VC for your venture, there are a tremendous amount of VC offices across the country. Some of them are focused in specific company that they'll invest in. So there are VC firms specifically dedicated for the medical industry, some in the tech industry, and so on and so on. So be very careful, find the right VC for your ventures. And of course, so why will they say no? There's many reasons why VCs will say no to your company. Your venture really doesn't stand out from the crowd, they really don't see the high growth potential that they're gonna make their billions off, their millions and millions, or their billions off. And don't take it personal if a VC firm says no to you. It just doesn't mean it's not big enough for them to take a risk at. They're looking for the big fish. They're not looking for the little ones in the market. Of course, again, finding the right VC is a full-time job. So it's not easy to get one. They typically don't give loans. Bank loans, right? Bank loans. Sorry, not VCs, but banks. A bank loan. So you're like, well, I can just go get a bank loan. Not so fast. Bank loans are for businesses is probably a very extremely difficult thing to get. A lot of banks do not give businesses loans, especially in certain industries. They'll shy away from. Banks, again, they don't give money to startups because they're too risky. So if you're a startup company, you can forget about going to a bank to get a loan because it's way too risky for them. Here is what banks expect business owners to have: capital, assets that can be used to create a product that can be sold or converted to cash back to a loan, collateral, personal assets to borrow against. So if you can't pay back the loan, they can take something away from you. So there's that. Capacity, a track record that the business has a capacity to generate income, and of course, credit rating. A poor credit rating will be turned down for you. So those are the 4 things that they must have. Of course, due diligence is a rigorous process carried out to evaluate an investment opportunity prior to being finalized. What is due diligence? Well, due diligence is a rigorous process, again, before the idea is finalized, right? Angel investors and groups don't carry as much due diligence due to many constraints. But of course, VC firms will definitely do their due diligence. One of the things about VCs, when they do their due diligence, they look for red flags. Of course, they look for the team, they look for the finances, they do a really good analysis of their accounting system, the books. So they really want to see if they're going to invest in this company. Again, they do a thorough research of the entrepreneurs involved in the company. Exits and harvesting. Again, VCs want to expect a return on their money, and they want to see an exit plan for the company. Do you plan to sell the company? Do you plan on IPO? That is where they want to see the firm grow, right? VCs expect a return when the firm exits the investment within 3 to 7 years, or 5. But they want to see their return on investments, and that's how they want their money repaid. Usually, again, the buyback, IPO, mergers and acquisitions. So again, IPO is a company's first opportunity to sell stocks. A smaller company may be bought out by a bigger company. So for example, if the doorbell camera Ring, it was bought by Amazon. It was once a startup, it was bought by Amazon. And of course, buyback gives the entrepreneur the opportunity to buy back the venture capitalist firm's stock. So those are just some of the ways, of course, the exits and harvesting. And of course, the last part, due diligence. Giving away equity may be, of course, one of your risks to lose your status as CEO. Do not be surprised if you do go out and raise money, and you get money from from a venture capital, or you get money from an angel investor. Don't be surprised if your role as CEO has been taken away and given to somebody else who the angel investors or angel investor or angel group or the venture capital firm believes is a better CEO to take their company to the next level than you. So don't be surprised if that happens, and that can happen. So again, by giving away equity in your company, you are making taking a risk of losing your position of the CEO, because those directors are starting to become decision makers. So be very careful. So there was a study of 212 startups from the late 1990s and early 2000 that showed that 50% of founders were no longer the CEO after 3 years. So be very careful. The late Steve Jobs was fired by Apple's board of directors less than 10 years after co-founding Apple. So just know, of course, he came back, but just be very careful. A startup may not have the expertise to market and sell a product or the financial resources at a later stages of the company. So again, full control can negatively impact success. So again, if you have full control, you may not see growth. If you give away too much control, you may lose control. So it's finding that sweet spot of, not losing all control, but not having too much control. So, and that of course is why it is very tricky to run a startup company, and why it's very not, running a business is not for everyone. So thank you for joining me in this chapter 13. Thank you.